Most people believe the middle class collapsed because wages didn't keep up, or because housing became too expensive, or because inflation slowly ate everything away. But what if I told you the real reason was not loud, not debated on TV, and not voted on by the public? What if the middle class collapsed because of one quiet banking rule that almost nobody understands, yet everyone pays for? This rule didn't look dangerous, it didn't sound greedy, and it was sold as something that would make the system safer. But over time, it did something far more destructive. It quietly rewired how money flows in America, who gets access to it, and who gets locked out. And once this rule was fully in place, the middle class stopped building wealth, without even realizing why. To understand how this happened, you have to forget what you think banks do. Most people believe banks take deposits and lend them out. That's the story we're taught. You deposit money. The bank keeps it safe. They lend a portion of it. Everyone benefits. But modern banking doesn't work like that anymore. Banks don't wait for deposits to lend money. They create money when they issue loans. Every mortgage, every auto loan, every business loan literally creates new dollars in the system. That means banks don't just move money. They decide who gets new money first, and that power changed everything. Decades ago, banks were required to follow strict rules about how much risk they could take. If a bank wanted to grow, it had to lend carefully. Local businesses, homeowners, manufacturers, and workers were the safest bets. The middle class was the priority. Then a rule changed quietly, buried inside complex financial reforms that most Americans never read and were never asked to vote on. The rule allowed banks to treat certain assets as risk-free or low risk, even when they clearly weren't. Government bonds, large corporate debt, financial instruments tied to markets instead of people. Suddenly, lending to Wall Street was safer on paper than lending to Main Street. And once that happened, banks stopped behaving like community builders and started acting like asset funnels. Instead of lending to families, they lent to funds. Instead of backing small businesses, they backed balance sheets. Instead of helping workers buy homes, they helped investors buy assets. The middle class didn't lose money overnight. It lost access. Access to cheap credit, access to opportunity, access to growth. At the same time, the wealthy gained something even more powerful than income. They gained proximity to money creation. When banks create money, that money doesn't enter the economy evenly. It enters where banks send it first, and banks send it where the rules reward them most. So, newly created money flowed into stocks, bonds, real estate portfolios, and speculative assets. Prices rose. Asset owners got richer, everyone else got higher costs. This is why the stock market can hit record highs while real wages stay flat. This is why housing prices explode while homeownership declines. This is why the economy looks strong on paper while families feel broke. The rule didn't destroy the middle class by taking money away. It destroyed it by inflating everything faster than incomes could follow. And because this process was slow, most people blamed themselves. They worked harder. They took on more debt. They delayed retirement. They skipped vacations. They blamed poor budgeting instead of a broken system. But the system wasn't broken. It was redesigned. Another effect of this rule was risk isolation. When banks were allowed to hold safe financial assets instead of making traditional loans, risk didn't disappear. It moved. Risk was pushed onto households, adjustable-rate mortgages, student loans with no bankruptcy protection, credit cards with compounding interest. Banks reduced their risk exposure while families absorbed it. The middle class became the shock absorber of the financial system, and every time there was a crisis, the pattern repeated. Markets were stabilized, banks were protected, assets recovered quickly, but wages did not, savings did not. Wealth gaps widened quietly, year after year. What makes this rule especially dangerous is that it doesn't feel like oppression. There are no lines, no soldiers, no visible force, just approvals that don't come, rates that keep rising, costs that never fall back down. People think the American dream disappeared. In reality, it was repriced, and only those closest to money creation could afford it. This is why two people can work the same hours, follow the same advice, and end up in completely different financial realities. One owns assets, the other rents them. One benefits from inflation, the other is crushed by it. One's debt grows cheaper over time, the other's savings lose value. This is not an accident. It is a design outcome, and once you see it, you can't unsee it. The middle class didn't fail the system. The system quietly moved on without the middle class. This channel exists for one reason: to make the invisible visible. If this perspective made you question something you were never taught to question, then you already understand why silent collapse exists. Stay with this channel, because the more you understand how the system actually works, the harder it becomes for it to work against you. The collapse didn't happen all at once. It happened silently. And here's the part most people never hear. Once the middle class was pushed away from money creation, a second shift quietly locked the damage in place. Debt stopped being a temporary tool and became a permanent condition. Earlier generations used debt to move forward. Buy a home, start a business, build stability. But under the new banking structure, debt became something you never truly escape. Student loans that follow you for life, mortgages stretched to 30 or 40 years, credit balances that never fully disappear. Not because people became irresponsible, but because incomes were no longer connected to asset inflation. When asset prices rise faster than wages, debt stops being leverage and starts being survival. And the system depends on this. A population trapped in debt cannot take risks, cannot walk away from bad jobs, cannot challenge broken systems. The middle class became financially disciplined but economically powerless. Another quiet consequence was how savings were punished. The same rules that rewarded banks for holding financial assets made traditional savings almost meaningless. Interest rates stayed below inflation for years. That means every dollar saved lost purchasing power over time. People did the right thing and still fell behind. Save more, fall further back. Spend carefully, lose ground anyway. Meanwhile, asset holders watched their wealth grow simply by existing inside the system. This is why financial advice feels disconnected from reality. Just save more. Just invest early. Just work harder. None of that addresses the root issue. The game changed, but the rules were never announced. What makes this collapse silent is that nothing looks broken on the surface. Banks are profitable. Markets are stable. GDP grows. But underneath, something essential disappeared. Upward mobility. The middle class used to be a bridge. You could start with little and build something solid. Now it's more like a treadmill, constant movement, no real progress. And when people feel this pressure but can't explain it, frustration turns inward. They blame themselves. They blame each other. They fight over culture, politics, and identity, all while the financial structure remains untouched. That is not a coincidence. A divided population doesn't question systems. It argues symptoms. The truth is uncomfortable, but it's also freeing. The middle class didn't lose because it wasn't smart enough. It lost because it was slowly removed from the flow of newly created money. Once you understand that, the world starts to make sense. Why crises seem to benefit the same people every time. Why bailouts exist, but relief feels temporary. Why costs rise faster than hope. This channel is not here to scare you. It's here to give clarity, because awareness changes how you move. When you understand how systems work, you stop playing by outdated rules, and that's where real control begins. If you want to understand the forces shaping your financial future, instead of reacting to them, stay connected to silent collapse. The most powerful systems are not the ones that shout. They are the ones that operate quietly, consistently, and without resistance. And now you can finally see one of them.